Welcome everybody to this morning's FSB webinar. Today we're going to be looking at employee ownership and whether that's right for your business. Delighted to welcome Jerry and Tom from RVE Corporate Finance. There's a little Q&A chat box in the bottom of your screen. Do put any questions in there for Jerry or Tom throughout the webinar, and they will do their best to answer. So without any further ado, gentlemen, I'll hand over to you.
Good morning, everybody. Can I just check that everyone can see the presentation screen? James?
Yes, all good.
Leslie?
Thanks, Tom.
Yes, excellent. Well, thank you very much for having us. My name's Tom Letherby. I'm joined by my colleague, Jerry Young. And we're going to talk today a little bit about employee ownership trusts. Now, the Federation of Small Business was involved in a publication which we sponsored. It was released back in September. It was looked in particularly at two questions. So first of all, trying to identify the scale of the ownership challenge within the UK. So there's an awareness in government that there are a large number of small SME businesses owned by the sort of baby boomer generation, and how are those individuals going to consider their own retirement? And the second part of the research was to interview a number of SME business owners and look at how employee ownership had served them in planning their own succession and helping those businesses carry on creating wealth and providing employment within their local communities. The report is available through the FSB website. It's also available through the Ownership at Work website, and you'll be able to read about two of our former clients. A fantastic business called B Looney, based in High Wycombe, that print promotional balloons. A very niche business that's been trading out of their factory for nearly 50 years, and then a fantastic education and training provider called Beacon, based in North London. It's 5-star accredited. And will carry on as an independent business, providing great quality service and also employment opportunities to the people of North London. They both of the leadership for both businesses provided responses as part of this survey, and I'm proud to say that they're both former clients of ours. So we've got the inside line for those businesses. Okay, moving on to the next slide. A little bit about us. We've advised that on over 30 EOT transactions. The business is founded by Jerry, who you'll hear from shortly, and also Mark. You can see there in the centre of the photo. We're based near Marlow, and a lot of our work actually has come from the Thames Valley area, but we've represented companies from all across the country. A little bit of the background here about employee ownership. Obviously, we're talking specifically today about a thing called an EOT, an Employee Ownership Trust. This was a structure that came into effect after the 2014 Finance Act, the budget then, which was, if you remember, the Rose Garden, David Cameron and Nick Clegg. That coalition government, and particularly the Lib Dems, were very keen on the idea of employee ownership. It's shown to help spread wealth amongst society, and it helps keep jobs local, which are two big problems that central government is looking to address. But employee ownership goes way back before 2014. Waitrose is one of our, in fact, the John Lewis Partnership is the best known example of an employee-owned business, and that was founded back in the 20s under a different structure. Lots of other names are sort of famous high street names are represented. Howdens, the insurance broker. Richer Sounds, for those of you that might read the Times at the weekend, Julian Richer, the former owner of Richer Sounds, sold his business to an employee ownership trust back in 2019. Stevens Scowns, a law firm down in the southwest that's owned through an employee ownership trust. They were the very first law firm to adopt employee ownership. And here you can see the if he's, I can't remember if that one's Wallace or Gromit, but the Aardman Animation Company based in Bristol became an employee ownership trust just a few years ago as well. And really, a lot of these businesses are looking, partly at succession, partly at the financial advantages that EOT brings, but also a lot of it's about independence and being able to maintain that corporate culture within the city and within the communities that they operate in. The tax benefits that I just mentioned are sort of twofold. First of all, for vendors, so the shareholders that are selling their shares to the trust, there is no capital gains tax due. There is it's called EOT relief. It's a little bit like business asset disposal relief or entrepreneurs relief, as it was formerly known. But EOT relief is uncapped, so you can sell whatever size company you like, and it's zero rated. So that's a very attractive financial incentive for people to consider EOT. And then secondly, if you're an employee of a business that's owned through an EOT, you can receive profit share distributions each year of any size, but the first £3,600 per year will qualify for zero rating for income tax purposes, although it will still be caught through national insurance charges. But it's a nice way, and when we tend to model EOT transactions, it's a nice way to give employees a little bit of a taste of what being an owner in the future might be like. Okay, here are some statistics that have been pulled together by the Employee Ownership Association. It's in growth, and as you can see here on this arrow on the right hand side, as the number of advisors and the number of businesses that have converted into employee ownership through an EOT has increased, word spreads, and actually the vast majority of our work comes from former clients that become quite sort of evangelical almost about the idea of employee ownership because it seems to tick so many of the boxes for them. Don't worry about taking notes. I think a copy of these slides or something similar will be circulated after the talk. One area here that you can see where EOTs seem to work best is amongst professional services type businesses. So although it does work in, obviously you can see there, a good number of manufacturing, construction and other types of businesses, professional services and what we might consider sort of asset light type businesses for whom it's best suited. We'll just move on to the next slide here. This compares an EOT sale to the various other types of option that people might have when they're thinking about their own succession or perhaps their own retirement. So how does an EOT transaction compare with, for instance, in the next column along, you can see here a trade sale? Or how does it compare with a management buyout using external finance, so bank finance perhaps or private equity finance? And then here on the last column, we have a management buyout with vendor finance. That's when you perhaps nominate, one or two of your managers in your business and ask them to step up into leadership roles and say that you'll back them with some sort of finance package to help them buy the business off you. And as you can see, there's a lot of green ticks here for an EOT transaction. It's a very, very flexible structure and can accommodate all sorts of wishes. We will talk through some of these in more detail. We're not going to have time today to cover everything in a huge amount of sort of granular detail, but we will cover the main points. And I'd encourage any of you with more detailed questions, please drop us a line. My email and phone number will be at the end of this presentation. Right, I'm going to hand over to my colleague Jerry now for the next slide. Jerry, are you there?
Yep, hopefully everyone can hear me and see me. Tom, can you?
Yes, I can, Jerry, yes.
Yeah. Okay, cool, good. So welcome everyone. As Tom said, I set up the business RVE over 5 years ago now. Me and my colleague Mark Butler were colleagues at PricewaterhouseCoopers in London in the corporate finance department. And yeah, we set up the business 5 years ago. And just like on this slide, to talk about how an EOT works, what the basic structure is. So the shareholders in the yellow box there, that could be owner managers typically. Most of the 30 or so businesses that we've sold to EOTs have been owner managed SME businesses with quite a focus in the Thames Valley area. So the shareholders sell their shares to the EOT, which is a trust. And the trust appoints trustees. Typically, the trustees are one of the employees, one of the founders, and an independent professional accountant or a lawyer typically. And those trustees manage the trust. The trust buys the shares at an independent valuation from the shareholders, so that the ownership of the company is now held by the trust. Most of our transactions have involved 100% of the shares being sold to the trust, but you can sell a lower stake, and the founders can retain a minority stake in the business if they wish. And in some of our deals, the founders have retained a minority shareholding in the company. The trust owns the shares on behalf of the employees, the orange box at the top. So the employees don't have share certificates. They don't own shares in the trading company that's been sold. They participate through the trust. And if an employee leaves the employment of the company, then they cease to have a share in the trust. So they don't have the right to any profit share entitlement, although new employees coming in obviously do participate through the trust. The trust buys the shares effectively on an earn-out structure. So the trust doesn't borrow money itself. It is effectively a shell company. So it is buying the shares from the vendors and paying for those shares through an earn-out structure, typically 5 to 7 years. If there is some cash in the trading company, so quite a lot of owner managers may have left cash in the business. If there's surplus cash, that can come out as part of the completion payment, but the rest of the balance of the payment will come out through an earn-out structure over 5 to 7 years. And all of that payment to the vendor shareholders is free of capital gains tax. Obviously, as a vendor, you have to wait, and there's risk attaching to that earn-out, just like any earn-out structure. So the trading company has to continue to generate the profits for the vendor shareholders to be paid out in full, but all of those payments are CGT tax-free. So that's the basic structure.
Thanks, Jerry. If I could just jump in here, we've had a couple of questions come through. The first one is for it's a large employer with lots of low-paid staff, and the writer asks, can a business with a large amount of low-paid staff work well? They're in the care sector. Can an EOT work well for that sort of business?
Yes, I think the only type of business I'd say maybe an EOT doesn't really work well for is if the company itself needs a lot of capital and a lot of investment to make it function properly and to help it grow, because the EOT itself doesn't have equity that it can put into the trading business. But a care home supplier, I mean, the whole idea of an EOT is you're energizing your workforce. I mean, if that's professional staff or whether it's low paid care staff or warehouse staff, the principle's the same. The structure is meant to energize the workforce, make them understand that they have a stake in the business, they own shares in the business through the trust, they're benefiting from profit share bonus payments from the trust, and help with retention, help with recruitment into the business, because you're offering something that your competitors are not offering their employees, which is profit share and a say in how the business is run.
In fact, I was lucky enough to speak to the managing director of a business, I think they're called Clean Tech. They became employee owned about 2 years ago through an employee ownership trust, and the managing director there, they have over 1,000 staff, primarily in facilities cleaning, schools and office blocks and things. And it's worked incredibly well because of that ability to pay a tax-free bonus, the staff retention and therefore sort of productivity for their organisation has really benefited. Okay, let's move on to the next slide. There are some more questions, and I promise to everyone we will try and answer all of them within the hour. Okay, let's talk through then the conditions for EOT relief, please, Jerry.
Okay, so to get this relief, EOT relief, similar to entrepreneurs relief as it was, except the rate is 0% and it's uncapped, unlike the old entrepreneurs relief, which is a 10% CGT and is capped at $1 million, but it works in a similar way. So first of all, you need to own the company as a UK tax resident individual. EOT relief is not available to institutional shareholders or corporate shareholders. It's a relief for individuals who are UK residents, UK tax residents. It's available if you sell shares in a trading company. So if you own shares in a property investment company or another form of investment company, EOT relief is not available. It has to be a company that's trading. You need to establish the trust in accordance with the relevant tax legislation so that all the employees benefit from the trust, which is, as long as you structure the EOT correctly, you will meet that requirement. It has to be an all employee benefit trust. The third one is the 40% rule. It's called the limited participator test. This is an anti-avoidance measure to make sure that the company that is becoming employee owned isn't effectively already employee owned or doesn't really have any shareholders who are not connected to the existing shareholders. So if you have 5 employees, one is the founder and the other 4 are the sons and daughters of the founder, then you don't have enough independent employees who will benefit from becoming an EOT. So broadly speaking, the company needs to have 5 or 10 employees, of which the majority are not related to the existing shareholders. So that's the 40% rule. Control, the EOT has to acquire at least a controlling interest, at least 51% in the company. I suppose the other condition, which we haven't listed here, I think someone raises about the valuation, and we will talk about the valuation. The shares have to be sold at no more than a market value. So if you don't have an independent valuation done and the EOT buys the shares off the shareholders at an inflated value, then that's likely to be challenged by HMRC, and you're not going to get EOT relief on the transaction because it's available up to the market value of the shares. And to establish a market value for the shares, generally speaking, HMRC would require you to show that someone independent has valued your business to establish the market value.
Jerry, can we just to talk a little bit about control, because one of our someone has asked the question about is 51% the minimum needed to sell to the trust?
Yeah, I mean, to get the tax relief, 51% is the minimum. Most of our clients sell 100%, because if you retain a minority stake and then sell that stake, let's say 5 years later, to the EOT, that minority stake does not attract EOT relief. So you will be taxed at the prevailing rate of CGT at the time in year 5. So you've got to make a decision. Do I want to keep some shares and sell them at a later date, in which case you don't get the tax relief? Or do I want to sell out everything today and get the benefit of the tax relief? The key thing is control has to pass. That's partly about 51%, but it's partly about the trust being independent and the directors of the company, you're not being able to control the trust. So HMRC, again, to get tax clearance for the EOT transaction, control has to pass. That means the trust must be independent, and at least 51% of the shares, voting and economic rights must be held by the trust.
Excellent, thank you. Just one last question that's come through that I think is relevant to this slide. Someone asks, would it be possible to convert an LLP to an EOT?
Yes. So we said, yes, you've got to be selling shares in a trading company to get EOT relief. You know, what happens if your business is held in a partnership? And partnerships were very popular in the 1990s. They were much more tax efficient. They're not really tax efficient now. You don't really see so many partnerships. But yes, you can convert a partnership into a limited company. It's called a complete business transfer. Generally speaking, that's not too difficult, and you can get what's called incorporation relief, so that doesn't trigger a tax charge. So yes, you have to transfer, you 2P your employees over, your employees transfer from the partnership into a new company. Your leases, your contracts with your customers all transfer into the new company. It's not normally a very onerous thing to do. And then once you own shares in the company, there's no minimum holding period. You could, if you wanted to, sell those shares a month later to the EOT. So you incorporate and then you sell to the EOT.
Excellent, thank you. Now, we give this presentation quite regularly with a slightly longer time frame. So there are 5 points here around structure and valuation, tax clearances, legal documentation, and trustee ownership. Now, we will skim, or I'm going to ask Jerry shortly to skim across them, but I can already see we've had a couple of questions which relate to the deal structure section. So perhaps let's start off with answering the questions, and that could be a good introduction to this part. So someone asks, is an EOT totally separate to gifting shares to employees? And how can you incentivize senior managers through this structure?
Okay, well, let's deal with that now. You know, outside an EOT, it's difficult to gift shares to employees. If you gift shares to an employee, i.e. the employee doesn't pay a fair market value to buy the shares, that is a taxable, it's like a bonus, you know, and it's subject to income tax. So you cannot just give your employees shares outside of an EOT structure. It needs to be in some sort of wrapper. We have employee benefit trusts, we have SAYE schemes. So you have to have some form of wrapper through which the employee can acquire the shares, or else they end up with a big income tax bill. So, you know, EOTs are a very efficient way of spreading share ownership very widely amongst your employees. But it is a very good question. Well, how do I incentivize the management, the people who need to drive this business, define the strategy, grow the business, if they only own the same share in the company through the trust as everyone else? Well, that's where you can put an EMI, enterprise management incentive, EMI scheme in place. And that can sit alongside the EOT. So let's say you have 2 senior managers who you think are the future of the business, they're going to drive the business. You could put 20% of the shares into an EMI scheme, 10% each for these 2 key managers. The EOT would own 80%, and the managers would own 10% each directly. And then as part of the management succession process, the founder retires through the earn-out process, the managers take over the management of the business, and then their EMI shares will vest, and they can sell their shares at the end of the earn-out period, let's say year 6 or 7, they can sell their shares to the EOT. So you've got a direct incentive for your managers, and that's very tax efficient as well. Shares held in an EMI scheme are not subject to income tax when the option's granted, and they're subject to 10%. Their BADR, 10% rate of tax on the first 1 million is available when the shares are sold. So EOTs can work alongside EMI schemes. So you can have 80% in that example owned by all the employees, so everyone's going to benefit. But these 2 employees benefit specifically, because you need to offer that type of incentive mechanism as part of the management succession planning.
Yeah, excellent. Thanks very much for that, Jerry. That addresses one question that we specifically had about how you could perhaps keep a share back for senior managers to provide, like you said, that incentive for them to stay and pay back the former shareholders. To the person that asked that question, please also remember you're the same person that asked the question about the care business earlier. It may not be an EMI scheme if your business employs more than 250 staff. There are caps and limits around EMI awards, but please get in touch with us afterwards, and we can talk through some of the specifics.
Valuation, should we?
Yes, let's talk through valuation. Yeah, and because actually there are loads and loads of questions, we'll have to deal with them. Let's go through this slide in turn and talk through the valuation process.
Okay, yeah. So valuation, as we said, the reason you get a valuation done is partly for the tax clearance, because you need to know when you're selling your shares that they've been sold at no more than market value, or else HMRC might challenge your EOT relief. Also, the trustees of the trust who are buying the shares, they have a fiduciary duty to the employees. They want to know that they're not overpaying for the purchase of the company. And the way, obviously, to do that, again, is to have the independent valuation. So it's been done for two purposes, partly for tax, for the vendors, and partly for the trustees as the purchasers, to establish a fair market price. Now, valuations of SME companies, they're typically done on a multiple of sustainable earnings. So typically that's pre-tax earnings, EBITDA, as the accountants like to call it, earnings before interest, tax, depreciation and amortization, which for most companies is the same thing as profit before tax, PBT. And a typical multiple of PBT or EBITDA is 5 to 6 times for an SME business. Now, obviously, if the business is growing fast, the multiple might be higher. If the business is in decline or not really growing, the multiple might be a bit lower. But as a rough rule of thumb, 5 to 6 times sustainable EBITDA is sort of a normal type valuation for an EOT transaction. We talked about surplus cash. If there's surplus cash sitting in the business, that would be on top of the business value, and that could be taken out, obviously tax-free, at the date of completion, because that cash is not needed in the business. It's not needed as working capital. It forms an additional amount of the valuation and can be paid out at completion of the transaction. Point 3 there, the tax clearance. So every EOT transaction really needs to be cleared through what's called the TIS, Transaction in Securities Clearance process. The good news about that clearance is HMRC are very good at clearing EOT transactions. This is not some sort of R&D tax credit scam where the relief is being abused. This is a relief that the Treasury and HMRC actually are encouraging you to make use of. So as long as the transaction is structured properly, we see clearances coming through in 15 to 20 days for EOT transactions. And you have to meet those. There has to be control passing, and there ought to be an independent valuation to ensure you get that clearance. But otherwise, it's not a difficult clearance to secure, and you're not having to run through hoops to try and convince a skeptical HMRC. They are pro EOTs. So once you've got the clearance, that's when the legal documentation would start. And at RVE, we do the tax work, the legal work, the valuations, and the structuring work. So we do that all in-house. So the legal documentation would be a trust deed, a share purchase agreement, the incorporation documents for the trust and the trustee company. But again, that is not a particularly onerous set of documentations. And the good thing about EOT transactions when you're negotiating with the purchaser, which is the EOT, is the EOT is not having to raise finance. The EOT is not trying to impose a lot of onerous warranties on the vendor, because the vendor's in a 5 to 8 year earn out process. So the vendor's got a lot of skin in the game alongside the warranties. So you don't have a lot of arguments about warranties and non-compete clauses that you would do in a normal third-party sale. So the documentation doesn't tend to hold up the transaction, and the whole thing typically would take 3 to 4 months to complete. A bit longer if you're incorporating a partnership. So the trustee company, which is the company that administers the EOT, as you say,
Jerry, we'll just jump in here. And we
Yeah.
have got a separate slide actually specifically to talk through the trustee company. But one of the questions asked, and this comes into the legal documentation section really, one of the questions is, after completion, are there any residual risks left for the vendor?
Well, yes. So, it's not sort of too good to be true that EOTs, I get all my money and it's tax free. Well, if you're a vendor, you do get the sale of your shares is tax free, but you have to wait in an earn-out structure 5 to 7 years to get paid. So yes, you do have risk. But if you sell an SME company to a trade buyer or a financial buyer, every single sale transaction will have some form of earn-out structure. It's very, very difficult to sell your company for cash up front. Any purchaser wants the founder of a business or the management team to have some skin in the game, be in some sort of earn-out structure. So yes, you do have residual risk, because the price that you have received is payable over 5 to 7 years. And if the business doesn't produce profits to pay back that purchase price, then you won't get paid in full. So you are taking risk, and one needs to understand it is an earn-out structure in an EOT transaction.
Yeah, and I think just to sort of revert to make reference to the slide that I shared earlier, talking about the various benefits that come with an EOT. Those benefits are due to an EOT because the risk isn't moving in the transaction. The vendors that carry risk as shareholders. And then once they go through completion, they then carry the risk as an unsecured creditor to the business. Now that carries, the words unsecured creditor, can ring alarm bells with people, but so can being a shareholder in a small company. So part of what we do in terms of legal documentation is to try and make sure that as many of those risks can be controlled by the former shareholders without them controlling the company. That's really important, is to make sure that the company is controlled by the trust, but clearly that large unsecured creditor, that the body that is the former shareholders, need to have some reassurances that the business is going to carry on trading successfully to make sure that their loan notes can be repaid in the future.
Yeah. And on that point.
Yeah, sorry, Jerry.
Yeah, so on that point, Tom, I mean, we've done over 30 EOT deals, and when you look at the structure diagram, if you're an owner of a business, hang on, I've sold my company, I don't have control anymore, but I haven't been paid. I don't like the sound of that. And yes, when you look at a structure diagram, that is true. You have sold your shares, and you do no longer control the company. But in all the deals that we've done, the founders tend to stay involved in the business. They're a director of the company. They're often sitting on the trust. Yes, they've lost control, but they are in a very, a key position within the company during their earn-out period. And the trust itself wants to foster the retention of the founder, or certainly a management succession process. So there isn't any conflict that you sometimes see between a buyer and a seller, where the person who's bought the company wants to exercise their own control over the business, make a lot of changes. It's understood that the trust owns the shares, but wants that company to generate the profits to pay the previous shareholders. They're not looking to make significant changes, change the strategy, change the management structure. So in all the deals we've done, those earn-out periods have continued with without significant change to the business. And the founders, they have certain contractual protections, as Tom said, in the legal documentation as unsecured creditors, but they also have de facto involvement in the business. And we haven't seen, that, conflict that you often see between buyer and seller in an earn-out period that you get with normal trade sales.
Yeah. Someone asks, is the 5 to 7 year period you mentioned a requirement?
Well, that 5 to 7 years is just a function of the maths, really. If you sell your company on 5 to 6 times EBITDA, unless your business grows very, very quickly, it's going to take 6 to 7 years to pay off out of future profits the purchase price. So certainly it could be longer. You can make the pay down period longer than 5 to 8 years, and allocate some of the profits to employees and less of the profits to pay down the vendor shareholders. But typically speaking, you want to create a shorter period, because this is part of the retirement planning for most business owners. They're happy to stay on for a few years for their earn out, but they don't want to stay on forever, for more than 10 years, for example, because it's part of their retirement planning.
Yeah. I'd also like to make the point that it's not the employees and the management of the business are not being tasked to pay out all the profits for a specific length of time. There is a debt, and actually, when I talk to the staff of the companies that we've acted for, a nice comparison is to talk about how the staff have effectively bought the house and they've been given a mortgage. So it's a specific amount of money, the loan notes that we're talking about, deferred consideration, as the lawyers would have us term it. That deferred consideration can be paid back as quickly, or hopefully not, as slowly, but it's an incentive to managers to make money and get that loan paid down as quickly as possible. And as Jerry said earlier, if there's an EMI scheme involved, the quicker they pay it down, the quicker that EMI scheme vests. Someone else asks, is there a suggested split between loan note payments and an employee bonus payments?
So, we tend to go with a structure where about 5 to 10% of the profits are allocated to an employee profit share bonus, and 90 to 95% of the profits are allocated to pay down the loan notes, the vendor shareholders' consideration. And then, as Tom says, when the mortgage is paid off, when the loan notes are being paid off, that 5 to 10% profit share can become 50, 60, 70% profit share, depending obviously how much the company needs to retain in the business for growth and working capital. So we tend to like to have a structure where employees can see some benefits of this structure rather than having to wait for 5 to 8 years for any profit share. So 5 to 10% shows, yes, look, we're employee owned. This means something. There's a small bonus paid in December. That's because we're employee owned. So it makes it come to life. But really, the main profit share only kicks in once the founders have been paid off in year 6 or 7.
And actually, that goes. Someone's asked the question saying, "Do all employees have to be involved in the EOT?" In a word, yes, is the answer to that question. If you're an employee, you are a member of the trust, or a beneficiary of the trust. Sorry. And if you cease to be an employee, then you cease to be a beneficiary. The lawyers have used the phrase "naked in, naked out," which I sort of quite like the idea of that. You'll have heard I think a week ago, the John Lewis Partnership announced its profit share. The business has made a profit, which they're very pleased about, but not enough to warrant paying any profit share to staff. That's the huge benefit of being an employee for a business owned by an EOT, is the profit share. It's not onerous on staff. There's no requirement for them to put money in. They might have to make a vote once in a while for their representative, and the only other, and then once a year, they're likely to collect some sort of reward, not for their effort. And this is the really important thing about an employee ownership. It's not about performance. It's not for effort. It's about being an owner. And that employee profit share is paid out by the trust because you're an employee owner. Let's move next on to the timetable slide. Now, if any of you in the audience have tried to sell your business already, this timetable will look like a pure fiction, because it will take, as Jerry and Mark, and in fact the whole team have been involved in corporate finance processes in the past, selling a small business generally will be at least a year-long process, and in some cases perhaps 2 years. And even after all that effort, there's no guarantee of success. With an employee ownership trust, there is nearly always a way to make an employee ownership trust work, provided your company meets those 4 qualifying conditions that Jerry talked through earlier. Because the risk is not moving anywhere, and it's effectively an internal transaction, this timeline generally seems to work. Things can be extended where there are third parties involved, particularly banks. Though actually, we'd say that over the years that we've been doing this, the banks have got much more knowledgeable and comfortable with employee ownership trust structures. So even the banks don't slow things down too much. But as you can see on the slide, typically somewhere between sort of 3 and 4 months, it is possible to bring about a sale to an employee ownership trust. Now, the role of the trustees, and this will, again, we've got a few questions that relate to this. Maybe we can jump into one of the questions first of all. It says here, are salary levels set in the normal way? And I guess they're trying to ask, do the trustees get involved in setting salaries? And is there a difference perhaps between normal employees and directors of the trading company, the salary that they receive?
Okay, so obviously a lot of SME companies are owned by the directors, and it's quite common for a director who owns the company to pay him herself, £10,000-20,000 a year, and then just take dividends. So they're not really on a market salary, which is fine. If you own the company, you can have salary dividends. It doesn't make any difference. You choose what's the most tax efficient. Now, when the trust owns the company, then you need to regularize that relationship. So typically the directors would go onto a market salary, and then the directors would need consent from the shareholders, who are the trustees, because you can't have directors just deciding their own salaries going forward. The shareholder always wants to know what that's going to be. So the directors get put onto market salaries, and there can be performance bonus schemes as well, just as you would expect to see. And then the trustees would need to approve any material changes to the directors' service contracts going forward. But it's not a very hands-on role. The directors in all other areas of running the business are operationally in control. They don't need the trustee to tell them what to do. That's just a safeguard for the shareholders to stop directors, awarding themselves ridiculous salaries without any control. So that's the only area where the trust would get involved in setting the pay. The directors set the pay for everyone else below board level in the normal way. Again, if you own the company, you might employ your son, your daughter in the business, and or your wife or your husband, and that's quite normal. Once the company is owned by an external shareholder, that sort of thing has to be done on an arm's length basis to stop, abuse of that situation, because and the shareholder's not receiving, a proper profit because money's being paid out to the directors or the directors' families. So that's where the trustee does have some oversight over the board, but yes, they have power to sack directors and appoint directors. yes, but that's generally only used if the board has become dysfunctional. And as I say, we've done over 30 deals. We've never seen a trust step in and sack directors. Sometimes directors leave or directors get ill and new appointments have to be made. But we've never seen a situation where, the directors have had their hands in the till, and had to be dismissed or been dismissed for underperformance, because the EOT structure, there's a good symmetry of interest between the shareholders and the directors. Everyone wants to generate profits to pay off the loan notes. So there isn't a lot of dysfunctional behaviour in the structure.
Yeah, thanks.
Okay.
Jerry, in fact, has explained to me in the past that the role of the board of trustees is very similar to that of the role of school governors, and it's not expected that the trustees have specific industry experience in the same way that school governors aren't teachers. What they're looking for, though, is that the business is being well run, and that the managers, the directors of the company have a plan and are delivering performance in the manner that is in accordance with that of an employee-owned company. The decisions are being taken generally in the best interests of current and future employees. Right,
So again, I should point out here, so if we just go back to that, Tom,
yeah.
Some people think, well, this is like, the business turns into like a shop steward's cartel, and the directors can only make decisions which benefit employees. So, but that's not the case. Just like John Lewis, the business itself has to be profitable and successful. Sometimes you have to sack employees. Sometimes you have to ask employees to do different jobs. Just like at John Lewis, people are being retrained off the cash registers, the checkout tills, I should say, and into other jobs as technology changes. So, the director's role is to run the business. The trustee's role is to make sure the board is doing its job properly to run a successful, profitable business, and also that the aims of employee ownership are being met as well, so that the board are not paying themselves 99% of the profit share and only 1% is going to the employees, because the employees are the shareholders. So that's the broad sort of structure.
In fact, that just touches on a nice a question we had earlier. How does the trust, either when there are loan notes being paid or perhaps when the business is debt free and it's cleared what we call financial freedom day, how would the trustees go about divvying up the profits amongst the employees?
Okay, so that's a very good question. So again, I mean, the John Lewis Partnership has a profit share policy, which is, say it makes £100 million of profit in a year. It may say the business needs to keep half of that for reinvestment. So there's a £50 million profit share bonus. And that £50 million profit share bonus is allocated to all employees pro rata to their salary. So that's their profit share policy, pro rata to salary. Some of our clients have a mix of years of service and pro rata to salary. Again, that's rewarding long service, and also rewarding people who have obviously higher salaries, generally have more responsibility in the business, rewarding pro rata to salary. So there are 4 criteria that are typically used: pro rata to salary, years of service, hours worked, so distinguishing between part-time and full-time employees, and just a simple headcount basis. Everyone gets the same amount. The most popular one is pro rata to salary. That tends to be how the profit share gets allocated. But again, it is possible to have the employee profit share scheme and also a performance bonus scheme. You don't have to have the whole bonus scheme done pro rata to salary. For some companies, for example, recruitment consultants, absolutely you need a performance bonus scheme, and also a profit share bonus scheme that is payable to all employees, and the two can sit side by side. So, the profit share is generally done pro rata to salary, but can be years of service as well. Short answer.
Okay, we've got just one more slide, and then we will go back to the questions. I'm aware that we've got 10 minutes left, so we'll finish off the slide for those of you that need to finish early, and then we will try and trot through the remaining questions. So there was a report written by Bayes Business School, what used to be called Cass Business School. A very well-regarded business school in the City of London. They wrote a report called The Ownership Dividend back in 2018, and it talked about what are the benefits of employee ownership firstly for employees and secondly for companies. And these are the what will form ultimately the founders, the former shareholders' legacy. What are you leaving behind? So typically, employees of an EOT-owned business will enjoy higher engagement, motivation, well-being. They will have financial advantages because their salaries are topped up by the bonus share in capturing some of the additional value that they create. And typically, people work within a much more transparent governance structure where decision-making and processes is quite clear for staff. For companies, you generally, because of that engagement and I'd actually say retainment of staff, you generally see greater levels of productivity. Employee ownership encourages employees to drive innovation and bring their creativity to work. This was seen particularly during lockdown, where a good number of the employee-owned businesses that we spoke to moved to a home working setup very easily because there's that level of trust amongst employee owners. And then finally, companies are shown to make improved this decision making because of this idea of long-term stewardship of value. Okay, we're going to move on to questions now. So there's one here. It says here, this is, I think, is going back to the EMI award. When the EMI scheme vests, does it trigger a new independent valuation? So I guess let's assume the loan notes have taken 5 years to pay down. The EMI scheme vests. What happens then, Jerry?
So normally the articles of the company will say, if shareholders other than the EOT own shares, they have an obligation to offer those shares to the EOT, a preemption right, and the EOT will buy those shares at an independent valuation. So, we would expect that independent valuer, yes, would value the shares, at 5 to 6 times multiples we've talked about might be the right answer. But yes, there would need to be an independent valuation done at that time. But that's not a big exercise. It's but you do need to do it. Again, the EOT wants to buy the shares at a fair price, and obviously the manager who's selling her shares wants to sell at a fair price too. So generally the articles will specify, yes, there needs to be an independent valuation, and that is the price at which the EOT would buy the shares from the manager.
Someone here, perhaps they joined the call a little bit late. They've asked about if there's a minimum number of employees to make an employee ownership trust work. That was covered quite early on in the presentation. But Jerry, what's the rough outline?
Yeah. So roughly speaking, it's the 40% rule. So if you have 2 shareholders who work in the business, you need to have 5 employees, including the shareholders. That's the 40% rule. The number of major shareholders in the company is 2. The number of total employees is 5. The fraction 2 over 5. That's 40%. Yes, that company qualifies. Well, the shareholders will qualify for EOT relief when they sell their shares. If there were 4 people with shares in the business and only 5 employees, that ratio would be 80%. So you're over the 40% limit. Your company, the shareholders do not qualify for EOT relief. So typically, where you have 1 or 2 shareholders in the company, you're going to need to have at least 5 employees, and those need to not be related to the shareholder as well.
Someone asks, how do new employees join the EOT scheme? So it's fairly straightforward. If you are an employee, you are a beneficiary of the trust. There are a couple of exceptions which I'll just run through. So there's normally a probationary period at the start of your employment. So perhaps your company has a 6-month probation period where you're working, but it's a sort of at will basis, and that relationship might come to an end, that trial period. Generally, you wouldn't be included as a beneficiary if a profit share award was made during that first 6 months. So that's the probationary period at the start. And then secondly, if you retire, normally the trustees have discretion to include you in any profit share award at the end of your time with the business. So if you left during 12 months before a profit share award, it would be up to the trustees whether you were included or not. Someone asks here, are there any issues with setting up an EOT initially rather than selling an existing business? So I think, yeah, it would be, there are, well, Jeff, businesses don't tend to start with employees. They tend to start with an individual. So I think our general advice would be to start trading and see how things go, and then think about employee ownership a little bit further down the line. Jerry?
Yeah, I mean, I suppose the question is, I'm thinking of setting up a business. There's going to be 5 people involved in the business. Shall we just do it as an EOT? I mean, generally speaking, I think when businesses start, they need direct share ownership to drive it and establish it. And then the next stage would be for the, to become an EOT. So I wouldn't particularly recommend an EOT as the way to set up a business to begin with. I think you need the direct share ownership to establish the business. And then once it's sort of mature, then yes, great, convert into an EOT. And you can sell. I mean, you can always sell. The person who's founding the business can always sell their shares to the EOT at a low value. They can't sell it at an overvalue, but there's no problem in selling it at an undervalue. So that option's always open to you to spread the ownership of the company much more widely once it's got going. And that could be part of your business plan. You can explain that this is going to happen in due course to the employee who's going to become an EOT in due course. But I think to begin with, it's best to have someone in control, someone to drive the business with direct share ownership, and then have an exit to an EOT.
Yeah. Okay, I'll just answer a couple of questions. Someone's asked, is payout made in equal installments, or can it be front loaded? That entirely depends on the performance of the business. If you go into employee ownership with lots of cash or surplus cash assets in the business, or as someone else has asked, something like commercial property, for instance, which could be mortgaged, then that's going to bring forward your payment profile. Fixed assets like commercial property can be used to secure debt against them and accelerate the pay down by the trust. Typically the cost, someone said excellent webinar, thank you very much, John Whitaker. Typically the costs of setting up an EOT, it's certainly cheaper than selling your business, but it is, as I hope today's given you a taste, it can be quite complicated, legal and financial. So it's something that is worth looking at. Generally, the way that we would do it is perhaps a quarter of our fee would be up front to a heads of term stage, which would give you and your fellow shareholders a very clear understanding of exactly what the deal is going to mean for the company and for the shareholders and for the employees. But come and talk to us. You can see my contact details, our website, are up on the screen. Very happy to take a call. I'm around all day today if anyone's got any burning questions, or email.
Yeah, I think, Tom, on that point, just to clarify, I mean, most EOTs are done without any external finance. So, let's say your company has £1 million of pre-tax profit. The multiple is 5 or 6 times. Let's call it 5 times. And let's say there's 3 million of surplus cash that's been sitting in the business that can be extracted. So the valuation is 5 million for the business plus 3 million for the cash. That's 8 million. 3 million comes out at completion. The other 5 million is paid out of the future profits over 5 to 7 years as an earnout. Now, the question is, could some of that £5 million, which has been paid as an earnout, be paid up front? If I could borrow, if the company could borrow from a bank, well, yes, in principle, some of it could, but you go to a bank, you might get 1 times EBITDA, 1 times PBT, you might get $1 million, and then you have lots of complications with actually paying out the balance of the 4 because the bank wants their debt amortized first. So we don't see debt in EOT structures very often, other than, as Tom says, if there's a large property value sitting in the business, then sometimes, yes, that can be used as security, and that can accelerate the payment of the 5 million in that example.
Okay, right. I think that calls time. It's 11 o'clock. Thank you all for some fantastic questions. I hope that's been a really useful session for everyone. I will turn off my share now. There we go. Stop share and bring back James. Has that worked?
Brilliant. Yeah, thank you so much. Jerry, Tom, thank you. That was really informative and super helpful. As has been mentioned, we will share the slides and some information around to everyone who's attended today. Do get in touch with them with any more questions. And again, any other sort of small business issues, do check out the FSB sort of resource online of where previous webinars of informative stuff like this has been up. And we will also put up this webinar on there so you can access it at any time. So yeah, please do use Tom and Jerry and likewise the FSB resource. Hope this has been useful. We will see you all again. Thanks so much for joining.
Thanks, James.
Thank you.
Thanks, Leslie.